You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Christian Szpilfogel, an exceptional guest and real estate investor out of Ottawa region of Ontario. Help me please to welcome Christian.
Thank you very much, Adam.
Thank you so much for being with us today, and I appreciate you taking the time.
My pleasure. Always love to help people out.
Thanks a lot. So I would like to start with the beginning for your business, how you started on multifamily.
That's an interesting question. So I got into it because I didn't know any better. I guess it's the simple answer. Because I had originally, my first building that I bought that was a rental was actually a 4-unit building.
Okay.
And the first true commercial property I bought was a 6-unit building, which was the second one.
Okay.
So I never really thought that buying a 4-unit or a 6-unit would be any different than buying a house, if you will.
Okay.
And so I didn't have any preconceptions about complexity or difficulty. So I just went for it. I had the 4-unit came up for sale. It was literally next to my house. It's a purpose-built 4-unit building. It's not a conversion or anything. It's literally a 4-unit building. And we knew the owners, and so we did that one as a private deal. I will tell you that I was very conservative about that one. I was nervous about the whole thing. You know, a lot of people tell you that, oh yeah, it was no big deal. I was worried because I was a single income family. So my wife was not working. She chose to raise the children. And so we had basically just one income coming to the family. So I underwrote that so conservatively. I spent about 4 or 5 days analyzing it on Excel spreadsheets, you know, in every which way that I could, thinking about things like, you know, what happens if interest rates would spike? What happens if I had extended periods of vacancy? How long could I sustain a negative cash flow situation if that were to happen? So I took that all into account. Once I convinced myself I knew what I could tolerate, I knew what my price ceiling was going to be. And so then when I got into discussions with the seller, he had definitely different price expectations than me.
As usual.
Mine was definitely lower than his.
Yeah.
And we had, it's a cute discussion in hindsight, because it was an elderly gentleman and his wife. He was about 6.5 feet tall, and she was lucky if she was even 5 feet tall. So she was just a little thing. And so the discussion went where we were negotiating back and forth, and I explained to him, you know, because he wanted, I think it was just over $1 million for the property.
When was that?
Downtown Ottawa.
No, when?
In right on the canal, beautiful area.
No, when this happened?
2005.
Okay, long time back. Wow, $1 million. Wow.
Yeah, it was about $1 million.
Yeah.
And
okay.
I went through the underwriting. I didn't really know what I was doing. I just know numbers. So I didn't understand things like cap rates and all this kind of stuff. I just figured out, okay, I needed to understand how cash flow is going to work.
Yeah.
And that's where I focused originally. And so I had the discussion, and I showed him, I said, well, you know, I understand you want $1 million, but when I go through the math, I don't understand how this is going to work if it's, you know, anything, you know, above 800. And so we got into a back and forth discussion about it. We'd gotten down to about 900 at that point. He was at 950, and then it came to about 900. And I said, honestly, I just can't, you know, 850 is my absolute limit. Otherwise, I'll have to walk away from the deal. And I could tell in his face, he didn't want to do it for 850. And then his wife, like I said, she was a little thing there. She looks up at him and she says, "They're such a lovely young couple. Give it to them for 850.
Okay.
And
Lucky you.
he looked at her and he says, looking down, right? He says, because he's so tall, he says, okay, I guess we're doing this for $850.
Yeah, the government said the last word. Do it. $850. Give it to them.
That's right.
Yeah.
So that was my first deal,
Yeah.
and they're a beautiful couple. We stayed friends after that, and I ended up buying another building from him later on, which we also did privately.
Okay. So when you're saying privately, you mean vendor take back, correct?
No, just private sale, no realtors involved.
Okay.
Yeah.
Okay. So the first question will be about your actual target market and criteria. So where are you actually buying right now? And regarding looking for actual deals, what is your criteria regarding internal rate of return, cap rate, especially with the current inflation on all over, I think Canada, not even Ontario. So what is your criteria basically?
Sure. Boy, that's a big question, Adam.
Yeah, it's an actual underwriting process. It's like maybe 7-8 pages on Excel, but if you want to summarize it in 2-3 points,
it sometimes results in that. But no, the way I look at it fundamentally is I start with the question of an acquisition of saying either the property is going to cash flow, right? So it's either cash flowing or I have line of sight to cash flow. Okay. So, obviously if it cash flows, that's a good starting point. And often it doesn't, but you get lucky. So the line of sight to cash flow leads back to a business case. So for me, the way I look at any acquisition is, if it doesn't cash flow right now, I have to figure out what I'm going to have to do to change the asset so that it does cash flow. And so sometimes it's simple. Sometimes it's just that the building is below market rent and the demographics support a reasonable rate of turnover for tenants. Sometimes it's more complex where you have, say, some units that are not ideal. It might be a building full of 3-bedroom apartments and the market in that area might dictate that it should be 1-bedroom apartments. So then you might split them up. Or sometimes it could be, we've done projects where we'll take it right back to the bricks or right back to the studs all the way back and convert them into higher and better use, whatever that might be. So in a pure residential application, for example, I have a project right now where we're converting a 7-unit building that was constructed in 1901, hadn't been renovated since 1929. And we're going to convert it to a 12-unit building.
Okay. Where is it?
That's in downtown Ottawa, in center town.
Okay. So you're basically focusing only on your local market, on surrounding areas of Ottawa, correct?
We do, but that's just by chance, because Ottawa has such a solid economy. There aren't crazy wild fluctuations where you'll see, because you have two parts of the economy. You've got the public sector and you've got the private sector. And they always tend to work opposite cycles to each other. So for example, when the private sector is suffering because we're in a recession, what does the government do? Well, they start to spend in order to stimulate the economy. That usually means that the public service spend goes up as well. So when private sector is suffering, public sector is booming. And likewise, when the private sector is booming, the public sector tends to back off a little bit and go back to balanced budgets. So we have this unique dynamic in the city where you end up with a very level, steady increase over time that averages, if you look over a very long period of time, it averages about a 6% rate of increase. Okay. So now the city's reached an interesting turning point because it just went over, about 2 years ago, it went over the 1 million person mark just in the city of Ottawa, not including surrounding. So the surrounding, if you include, for example, Gatineau, which is on the Quebec side of the river, about another 500,000 people. So we've got about a total of 1.5 million. And so the population growth is accelerating, and the growth of housing is accelerating in commercial development. So we started buying in tier 2 towns just outside of Ottawa. So we still buy stuff in the downtown core, but obviously those are much more involved projects that require significant repositioning projects. Whereas if you go to tier 2 towns, if you're careful, you can still find stuff that'll cash flow on acquisition. And I just did an acquisition of that in March. I bought a portfolio of buildings that cash flowed on acquisition, but the rents were still 30% below market. So as the tenants turn over, I've got a huge upside in those particular projects. And they're beautiful buildings as well.
100%. Yeah.
Yeah. 100%. I love picking up buildings that I like looking at. Right?
So for this point, I want to ask you about the challenge of Ontario rental market, whereas there is no rent control and it's not investor friendly. So right now, what is your approach for refinance? Is usually force appreciation right away, or cash for keys, or waiting until renewal? So what's the actual strategy for refinance?
Yeah, absolutely. So when I do an acquisition, I take a look at the demographics in a building, right? And so I tend to take a very ethical approach to things. I don't like to disrupt people's lives. I don't feel that that's fair. And if you're, for example, if a building was full of seniors, I just can't, get around the aspect of trying to encourage them to leave or to force them to leave. It's just, I see elderly people and I think of my own parents and what would I want in that scenario, and I can't do it. So, whereas younger demographic, people that are in their 20s and 30s, they have natural life events. They're, getting together as couples, they're separating, they're having a child, they're, they're moving, their career takes them somewhere else. So they're highly mobile, and so they turn over quickly. So if I see a building that is largely 20 and 30 somethings in the building, then I know that I'm not going to have to do anything crazy in order to be able to get that done. So if it's a building full of seniors, I typically won't even touch it. If it's cash flowing, I will, but if it's not, and my business case relies on tenant turnover, then that business case, the way I would execute on it would take too long, and therefore the internal rate of return would ultimately be too low. But if it's a younger demographic that I know it's just natural life will get them to turn over, and my business case will fundamentally be better.
So what kind of cap rate right now you're looking for on all of your deals?
So as long as it cash flows, right? So that's the way I look at it in the first place. Yeah. And then the cap rates, I look at sort of a secondary thing. It's more about using it to define the value of the property, either on acquisition or on refinance. So a cap rate will give you an idea whether it's going to cash flow, but when you think about it in the context of your overall business case, that's what really matters. So you asked earlier what some of my criteria were, and I'm usually looking at, whether it cash flows. I look at my initial cash on cash return. My exit is almost always an infinite cash on cash return because I'll do a complete equity takeout on the refi. And then the other major hurdle for me is the internal rate of return, or IRR, needs to be greater than 30%.
30 or 13?
30.
Wow.
Yeah.
IR, okay, it's a lot. Okay.
Yeah. So that's my hurdle. So, and one of the reasons I have that hurdle is, let's say I'm doing a repositioning project or a new construction project. Then if I have a hurdle rate of about 30% on that, then the odds are that I'm going to be able to get all my equity out. And the further north of 30% I am, I get to take extra equity out. So every one of my projects, or the vast majority of my projects, I should say, are ones where once we're complete, we'll do a refinance. My initial working capital that went into it, including any construction costs that went in, that all comes back out, and I'm usually looking to take extra money out. So that's the way I think about it.
Okay. My next question will be, you know what's happening now on the last 4 months, 3 months, starting from February. What's the current market performance now after the new spike of interest on inventory prices and the impact on multifamily right now on Ontario region, or not Ontario, Ottawa region?
Yeah, so the impact is, so here's the thing. The retail market, which I classify as single families, duplexes, triplexes, even up to fourplexes. I consider that the retail market. And then you've got the commercial market, which is, basically 5 units or more in a building. It might have traditional commercial such as office, business, etc. They are valued differently and their dynamics are different. So when we take a look at the retail market, say, we'll use the obvious example of a single family home. That does tend to respond quickly to interest rate changes because it affects people's affordability on those particular properties. And if we take a look at what's happened in Ottawa, there's been a bit of a slowdown, right? And by slowdown, I don't mean a drop, right? I just mean that the activity levels is dropped off on that side. Now, I don't do stuff that small, to be fair. So I don't see it day in and day out. I only know what my realtor friends are telling me. What they're seeing is a lot of sellers are getting nervous that they may be missing the cycle. And so a lot of houses are coming onto the market very quickly. And then, of course, you get the other side of it, which is with interest rates, you've got an affordability question. And so that tends to slow things down a bit. On the commercial side, interest rates and cap rates have a strong correlation. So when interest rates go up, the cap rates typically have to go up too, because the profit is largely made in the spread between what the cap rate is of the effective cap rate of the building and the cost of money that you have underneath. So they are directly related, but offsetting that, particularly in the small end of the market, is that there's so little inventory for multifamily property. In Ottawa, the volume of multifamily property, I think last year was in the order of maybe 35 buildings turned over.
Wow.
So, and that's in a city of 1 million people. So that's very low turnover. So when it comes on the market, and I bought a property last February, that's the 7 unit that I'm converting to 12. I was one of 16 offers on that.
Wow.
It was a highly competitive environment. Everybody wanted to get in on these things when they become available. So as if interest rates continue to go up, and I think that's a whole other open question as to whether or not they will, and whether or not the central bank can really continue to support increased interest rates in the long term. But assuming that they do, what you should start to see, especially on the larger buildings and starting to migrate down into the smaller buildings, is that their effective cap rates are going to go up, and therefore their price will go down a bit.
100%. The competition also, because eventually you're looking for the cash flow. So if the interest rate is going up, the sellers have to lower their expectation because to make sense. So it's not gonna work with high prices anymore. So less competition, of course. So regarding your business model for raising capital, how you start to work on closing deals. So are you raising capital, or are you working with joint ventures? Are you looking for vendor take-backs, promissory notes? What is your approach on this?
Sure. And first of all, I'll never say no to a good vendor take-back deal. I've done a number of those. Some of them are been outrageous deals, right? It's often a great way of buying an underperforming asset at a way that will actually get it to cash flow, or where conventional financing isn't going to work, and the seller knows conventional financing isn't going to work. So unless someone comes in with deep pockets, they're not going to get the full value of their building. But if they do the financing, they can often get something more to what they actually want. So that's a great technique, and I've used that quite a bit. We don't go to external investors in terms of, I mean, we would take private loans, but we won't take equity partners in. We don't do joint ventures. We're fully self-financed. And that was a conscious decision when we started. We wanted to be in a position where we had full control of our portfolio all the time. So that if we needed to do something different, we don't need people's permission in order to make that happen. So it gives us a tremendous amount of flexibility in terms of how we manage our portfolio. And then what you find too is as your portfolio grows, you end up with quite a bit of working capital to be able to do these acquisitions. So I probably have about three or four refinances that are going to happen on the back end of this year. That's going to generate all kinds of new working capital. I'm probably going to use that for new development projects that we have. We've done a little bit of land banking. So that's what we're likely to do with it. And on that one, it's always a test, right? It's like sometimes it's cheaper to buy a property and reposition it, right, with your working capital, and the business case is better that way. Sometimes when buildings are too expensive, you build instead because it's cheaper to build it than to reposition it. So depending on where we are in the cycle, we'll build or we'll buy.
Okay, about this, because now you're comparing between two strategies. The first one is a debt partner. The second one is equity partner. My question is always that because you're following the debt partner strategy, which is for me, it's challenging because you have always to perform, because if you're not performing, the debt partner is going to get, is he going to come and take the property, which is harder to swallow. But on the other part, which is where you have equity partner, yes, you're giving control, but you have 5, 6, 7 years to perform. And I understand it, but I understand what you choose is more challenging, but it's showing that you are really performing and you don't care about the challenges. 100%.
Yeah, and with the debt partners, I mean, most of my debt is with commercial lenders. It's not with private lenders. And I have a good reputation, right, amongst the lenders, especially the commercial lenders. So when I'm presented, there's usually not an issue of getting mortgages. The other thing that I do, and the lenders are aware of this because you have to submit your net worth or your balance sheet for your operation. And they know that my debt to asset ratio is relatively low. So I'm not highly leveraged. I might be highly leveraged on a particular deal. Okay, so I might take it at 90% or even go to 100% on a particular deal. But across the portfolio, I don't let the debt to asset ratio go above 65%. Okay, and that's strategic because one is I look better to lenders, right? So they go, okay, this guy's got a lot of equity. He's not going to default on payment. And even if he did, right, there's enough equity here to fully pay us back plus all our costs, et cetera. So they see that. The other is that it's a defensive position from my portfolio perspective. So, you know, the economy is incredibly difficult to predict. You just don't know what's going to happen. Not really. You might have a good guess, but then, you know, a pandemic hits you, or the Russians invade a country, right? Or, you know, whatever it happens to be.
Not again, enough one country.
You just never know. So, so what's going to happen? So I take a defensive position in my portfolio that says that if we went through a significant market pullback, I want to know we're going to be okay. Okay. And then I also defend it in the way, you know, people are always talking about variable rates versus fixed rates. On the commercial lending side, it's almost always fixed rates anyway. But I tend to think of it more as a fixed rates can be an insurance premium as opposed to just a cost of money. So what you're getting with a fixed rate is peace of mind in terms of predictable cash flow going forward. So I have a certain cash flow requirement in my business, and I need to feed people, including myself. But I need to, my employees, they need to get paid. The contractors need to get paid. All these expenses need to be done. So I tend to focus more on fixed rates for about maybe 60, 70% of my debt will be on fixed, probably closer to 70. And what that allows is a very predictable cash flow situation projected over time. So then I know that my business is not at risk. And this is something a lot of the really big people do. So if you're looking at the Mintos or the Homesteads, the Paramounts, the larger guys that are out there, the Hazelviews, they're often looking at very long-term debt. So they'll have an asset and they won't be looking at just a 5-year, mortgage. They might be locking in for 7 years or even 10 years, because then the business case is highly predictable for that particular asset. The cash flow is very predictable for that particular asset.
Okay. We mentioned before, like we were talking before, me and you, about the development part on your business. Can you highlight your business strategy when you're doing land development or development on your project? If we can highlight what micro strategies you're following on your business model for the development projects.
Mm-hmm. So again, I always look at it as a business case, as we talked about earlier. I'm usually working on repositioning exercises, and often where I'm trying to get highest and best use. So sometimes that highest and best use works within the existing zoning. Sometimes it doesn't. Sometimes a particular asset isn't even maximizing the entitlements on a property to get to maximum density. But the typical process that we use when we're doing a repositioning project, especially if you're doing anything, at least in Ottawa, if you're doing over a 3-unit building and you're adding another unit, you need to go through a process called site plan control. And site plan control is like a regular development application, but it brings around a bit more scrutiny about your demand on services and resources in the community, how the building fits in with the rest of the community and how it looks on that particular street. So there's a lot of stakeholders involved. So for example, on a project that we're working on, I just got an email from Bell Canada that wants to do a bunch of due diligence associated with our project. But at the end of the day, what they really want to know is, can we put our fiber into your IT vault in the building and service your building? I know that's what they're really asking. But they then are part of the approval process to say whether they have any objections to the project or any input in terms of what they want to see done on that project. So it's quite an involved process. And depending on the size of the project, it can require just staff approval, or it could require approval by council, or it may require public consultation.
Yeah, it's based on the criteria of the actual land zoning, I think. Because you mentioned the building from 7 to 12. Can you go through the? I'm sorry. Can you go through the actual process with this one? Because it's interesting, especially changing the zoning from 7 to 12. You need utility request. You need the zoning to be changed. You need public hearing and approval. And as you mentioned, councillor. Can you starting the process from the beginning? Highlight of it.
So going from 7 to 12 absolutely has to go into a site plan control process. It can go through with staff approval, which is good, but a councillor, the ward councillor, will still sign off on it on the recommendation of staff. But often when you're doing something like this as well, is you also end up with variances. So even if you fit within the zoning per se, especially if you're working in the downtown core, there's always something that is going to, because those buildings were done before modern zoning bylaws, they always have some variance. It might be side yard setbacks, backyard setbacks, front yard setbacks. And so I have exceptions to do on that. So we'll get to variances and committee of adjustments as part of the discussion. But when you start that project, knowing that you have to go into site plan control, you know that you have a number of inputs to that site plan control. So site plan, as part of its inputs, is going to require, for example, a full architectural plan, including all the build specs. It's going to need a topological survey. It's going to need an environmental report. Depending where it is, it might need a traffic noise study. I'm just trying to think, there's just a whole long list, and it depends on where and what the project is. So you end up with a long list of engineers that have to create all these documents for you, and you'll be spending tens of thousands of dollars on them, right? There's no sugarcoating that. Like even my water servicing engineering plan is that one probably cost me about $8,000 or $9,000 for this project. Phase one environmental is easy. It's only about $2,500. It's very common anyways that you have to do them for multifamilies.
How much is cost you the pre-development? How much is cost you the pre-development like so far with the engineering cost and?
Probably about $50,000 before I even submit the application. The application is about $23,000 just for site plan. Okay. And then each unit that we add, so we're grandfathered for the first 7 units, the additional 5 units will have about a $15,000 development charge for each unit added on top of site plan, and a cash in lieu of parkland fee, which is probably going to be in the order of about $20,000 a unit. So each unit is another $35,000 in soft costs associated with just the development fees, plus site plan application of $23,000, and if you add the engineering documents, about $75,000. So what's
250? So 250, 175 for the city, another 25 for the city for the application, and 50 for the engineering. 250,000.
Yeah, so it'd be 5 times 35. So yeah. Plus another 75 on top of that. And that's. And if in a significant renovation like that too, you've got CRA's rules, whether HST is attributable too. So when you do a project like that, and depending how we end up doing it, there's some workarounds, but if you were to just take it straight back to the bricks all the way through, then you're caught in CRA substantial renovation as well. So then you have to charge HST to yourself at the end of the project. So every level of government gets some piece of the pie here, right? And you were doing the math pretty quickly, and you're, before you even think about HST, you're well into $250K in soft costs, and we haven't even bought a nail or swung a hammer yet.
Yes. Okay. So this is you're gonna add another 5 units. Each one is about 150, I think, for construction.
So each unit will cost me, just in development fees and cash in lieu of parkland, it's going to be $35,000 each. So times 5, so that's 175.
Yeah.
Plus estimating about 75 for costs associated with the site plan control. So that brings you to 250.
And the actual construction, how much per unit?
Well, how much is a loaf of bread, right? And how long does it last?
Do you find material first? There's no material on the market. This is same.
It's challenging for sure.
Yeah.
And we'll adjust the pace of our construction based on development costs. But the budget for that, all in, including the soft cost, is going to be about $2 million. Okay. I think I can do it for as little as 1.5, and my outer bound is about 2.5 million. So I've got my best and worst cases in my business model.
So the lending part here for the development, what is the challenge? Just for the people to understand the development part for the lending, this is supposed to be a commercial loan for developers, so it's going to be 50% loan to value, correct?
It depends. Again, so I have right now on this a 75% loan to value. And that was based on market rents, not even existing rents. So I got it at about 75% loan to value, and they've given me some construction draws on top of that in order to complete the project.
But the 75 on the existing 7 units. I'm asking about the new 5 units. No. You're going to get a new loan at 50% loan to value, correct? No.
So when you're doing if you do a repositioning project, there are certain lenders that like to do simple repositioning. So if I was just doing a 7-unit refresh, then you could go to somebody like Equitable Bank and they'll finance a 75% loan to value, and then they'll give you a couple of construction draws that once you've completed certain stages of work, you basically go back to them, they get an updated appraisal, and they loan you more money against the asset. So you keep rolling it forward on your construction. So when I talk about, say a $2 million budget on construction, I have to front some of that because I have to do the initial construction cost. But once I've demonstrated and increased the value of the building to a certain level, so maybe it's once I've got all the framing complete and it's serviced, but not necessarily the finishings, I can go back to the lender with an incremental appraisal on that building and get another draw on that particular loan. So all this stuff is agreed up front before you start the project. So you're getting a base acquisition loan, and then you're getting construction draws on top of that as you go.
Based on your schedule. So you're going to be, based on your schedule, you have to be clear about 3, 6, 9, 10, 12 months like project schedule. And based on this, you start to submit the documents to have draws or take draws from the construction loan.
Yeah, they're usually looking for budgetary values and where the thresholds are going to be, and then they hold you to those budgetary thresholds. So I might say, for example, that I'm going to do, I don't know, let's say 3 draws or 4 draws of $500,000 each. So I'll need to float the first $500,000 or $600,000 to get the work done, and then what I'll do is I'll go back to them at that point, say, okay, the appraisal's been updated. We've done this much more value in this particular project, and then the lender will forward. It's usually not the full 500, but they'll give me a draw of like maybe 375 or 400 on that. Okay. So then I roll that forward into my working capital. I go to the next tier. I do a second draw. And so it just keeps rolling forward like that. And then when you get to the end of your project, you've got your as completed appraisal. And then you normally do a refinance and pay out the construction loan. Okay.
So regarding this part, how you structure the deal between you and the developer, the operational partner? I'm not sure if you're the operational partner or not, but how you structure it?
Yeah, we do this all in-house.
Oh, okay.
Yeah, so we're our own general contractor. We have enough units that we're doing turnovers all the time. So we have staff doing that kind of stuff. But when we're doing a repositioning project, we go out and we get a builder, but we act as the GC in that situation. So we'll manage, the framers, we'll manage the drywallers, we'll manage the plumbers, the electricians, the roofers, pavers, all this kind of stuff.
So how big is the team, by the way?
Our team is a total of about 5 people, so it's not that big. Okay. But then we do a lot of subcontracting work as well. So our plumber is not on staff, but we give him enough work that he's very reliable and is responsive to us. Our electrician, again, as a contractor, we do a lot of work for him, and that's a key thing, right? Like, if you keep these guys fed all the time with your projects, when you need them to do another project for you, you're going to get prioritized much higher, and they end up being much more reliable. So doing volume is just a really important aspect in this as well. But that's typically what we do. So for a construction build like that, we'll pull in structural framers, we'll do general finishers, we'll do drywall people, etc. And they're never on staff. We just hire those as we need them.
So especially on this part, when you're qualifying for the construction loan, I think you need to show the builder resumes and the other trades as not as a GP, like as a partners on the GP team, because you are the general contractor, and I think they need the builder resume or experience on the actual underwriting documentation.
Yeah, so we have that track record. Yeah. So the 7 to 12 is not our first rodeo. Okay.
Oh, okay.
I have an investor resume that I share with the lender so that they can see a history of our project. So that's credibility. I typically do a personal guarantee on this. It's almost inescapable in Canada anyway. So they know that I'm good for the money. And so that de-risks the lender quite a bit. And they don't necessarily need to see our staff or the contractors underneath. They just need to see the budget and the plan associated with it. And then, of course, the other two things that they need to see is the as-is appraisal and the as-completed, right? And you're working towards the as-complete particular appraisal.
Yeah. At the end, and as you mentioned, at the end, you reappraise, get refinance, and pay the first construction loan, which has been withdrawn as a drawn like different phases during the construction project.
Yeah.
If we can break down on one of your biggest deals regarding or your latest big deals, how you get the deal, what was cap rate for it, did you refinance it, what was the building class, what was the upside about the project? It's going to be great.
Okay. Okay. So do you want to see an example that is like completely done and already refinanced? Or
I think so. Yeah, especially because it's going to show the actual clear picture about the 5-year performance, or at least the returns, because you mentioned that you're focusing especially on high returns, which is, you said, IRR 30%. So it's really high on the above the market ratio, like usually 22, maximum 22, but 30 is like really high on force appreciation or BRRRR. So it's going to be great if we can break down one of the deals.
Yeah, sure. Okay. So I'll take one that I did I bought this property in 2017 and we refied it in mid-2019.
2 years.
I've publicly disclosed these numbers in a webinar recently as well. So where I show the actual math associated with it in fine detail, but I'll go over it roughly. In that webinar, there was I show the income statements and the balance sheet, right, through the phases of the project, which I think would be interesting for people. But it really kind of worked out to this. It was a triplex with an illegal unit in it. It was in a very nice neighborhood, surrounded by people that were, they're doctors, lawyers, professors, you name it. So, it was a high income neighborhood. And this one building was a sore in that neighborhood. It was the building that everybody goes, like, if something went missing, they knew where to find it. It was somewhere on that property.
Yeah. Okay. And in rough condition.
It was in rough condition. The tenants were had their own challenges, not all of them, but some of them. One was quite frankly a thief. And he would steal from nearby construction sites and then resell it, kind of on the black market, if you will. And then there was another tenant who had serious substance abuse issues. And when we were demolishing the units there were all kinds of needles that we found under the floors, etc.
Wow.
So it was in really, let's say, challenged situation. So you can imagine when I have to go to variance, for example, a committee of adjustments, I explained to the neighbors what we were going to do. We were going to turn this from a rundown triplex to a sixplex. And with good quality units and tenants that fit the demographics of fitting into that particular neighborhood. So typically professionals, etc. So with committee of adjustments, it's always a risk management thing. So when you're asking permission for a variance in a committee of adjustments, you have to remember it's a political body. Yeah. So you need to de-risk their decision. They don't want a decision to come back and haunt them because it just makes them look bad, right, to the people that appointed them on that committee. Yeah. So I go in with, very reasonable requests and with benefits to the community. And then I get the neighbors to sign off on the plan. so that I submit my application and say, the neighbors support what we're doing. Okay, so now it's even less risk for the Committee of Adjustments. And the vast majority of times when we go through Committee of Adjustments, we're in and out in under 10 minutes, right? Once we get to the front for our hearing slot, we're out in 10 minutes. There might be a lot of waiting before that, but it's pretty quick. So in that particular project, the original plan was to do a simple, tear down the walls and reconstruct it into a 6-unit building, but the building had a lot of challenges in it. We had part of the foundation collapse on us. We had, when we pulled away a lot of the plaster, we could see that somebody at some point in its history had cut through some of the joists because obviously they were inconvenient. So
let's cut it.
Oh, it was
no need for it.
It was a long process. So we issued N13 reason ones on this because we were fundamentally demolishing the interior of the building and relaying out in a completely different format. So that's valid for an N13 reason one. And that's an Ontario thing. I know your viewers are nationwide. And probably international, actually. So that's what we used as part of our rent control process, or the Residential Tenancies Act. In any event, so just talking about it from a numbers perspective, we acquired that building. I think it was $775,000 is what we bought it for. And there was competition at the time, but we managed to get a decent price on it. We put in probably about 700,000 into that development. So we were in for about, what's that, about 1.45.
1.45, yeah.
Now we could round it to 1.5 for fun. And it appraised, when we were done, we appraised it at 2.1 million. So, and we had CMHC financing, or sorry, CMHC insurance on the financing, and we got a 40-year amortization on it as well.
So how you closed? You closed with CHMC, or you closed on CHMC or hard money?
The refi was done with CMHC.
The refi, but the actual closing.
The closing, it was conventional financing.
Oh, okay.
We did that one, I think, at 80% loan to value because it was a triplex. It uses
residential. Yeah.
So that one was done with TD. We did it on a 2-year term, and I think it was 80% loan to value on that one. And then on the refi, it was obviously a commercial mortgage. And I think I did that one with First National, but we did it with CMHC underwriting as well.
Insured mortgage.
And it was great. So we got that one, I think, was close to 85% loan to value.
The maximum of CHMC.
CMHC will do it up to 85% loan to value, but they underwrite very conservatively. So sometimes it's not quite what you think. But writing to it, CMHC underwriting criteria, it was valued at 2.1 million with I think just about 85% loan to value. And the bonus here was the 40-year amortization.
Did you have any green system? Because I know that they offer some ease on the DSR. Like usually they go with 1.2 or 1.3, but if you have an actual green system like solar, they can lower it to 1.1. Did you have anything like that?
I think you're thinking of the CMLI program, which is for new construction.
It's supposed to be new construction. What you did is new construction, basically.
That's for that program. It's new construction, right? And there's certain point system associated with it. I haven't used it yet, but I'm probably going to be using it on a project this year. So I'm just about to go into that process. But for a conventional refinance, it's just their standard underwriting process. There's no extra points that you're really looking for on that. So that process is, it works actually quite well. And so in that case, I got 85% loan to value and a 40-year AM. So the cash flow was fantastic. And that's the key piece, right? Because if you're looking at your debt service ratio, right, which is effectively, the relationship between your net operating income and your debt. So as you're saying, right, that DSR should be typically at least 1.2. And in my experience with CMHC, it ends up being more like 1.3. If you kind of look at it, with their conservative underwriting. So if because of that, if you can get a longer amortization, right? And because this is effectively a new building once we were done, I was able to get a 40-year amortization, which means my principal and interest payments are lower, which means my debt servicing is lower, right? Which means it improves my debt service ratio. So it's not just about underwriting it to a conventional 25 or 30 year. You do want to take a look at extending the amortization period because it actually improves your loan to value on that particular asset.
I think it's only working with CHMC. Regular A lender doesn't offer 30 years, or I mean 40 years. Only CHMC offering this, correct?
So CMHC is an insurer, okay? Yeah. So it's the lender loans me the money and they will loan it to me on that amortization schedule because CMHC has insured.
Yeah, accepted. Yeah, okay. Yeah. But so, if there's no CMHC, regular bank is not going to accept this unless the insurer can accept it, correct?
That's right, because they want their money protected. Yeah, so that's where, because you have CMHC, you have longer amortization, you have typically your interest cost will come down as well. In my experience, it usually results in a full point off of the rack rate price. So it's usually a good discount there. And then you get a higher loan to value. So you are left with less money in that particular deal, if anything at all.
Okay. My next question will be how you can have your constant pipeline of deals, how you always find deals, if it's wholesalers, commercial realtors, maybe MLS. So how you created this constant pipeline to your business?
It's an excellent question because I think this is the number one area that people struggle with. So I think a lot of people don't do proper underwriting on their acquisitions. Okay. And I think people really need to learn proper underwriting for acquisitions in their business cases. So we'll take that as a given. The second biggest thing, but the one that most people end up focusing on is their deal pipeline. I don't think I have a magic recipe for this. The reality is that I develop relationships. I do a lot of networking. I get to know people in the community. I get to know the realtors. I develop a reputation that we're closers, that we know what we're doing. So if someone brings me a deal and I put an offer on the table, I'm going to close. There's no doubt, right? From any of if the broker's involved, et cetera, they know I'm going to close. So that has a lot of credibility with a seller, because you can imagine if a seller is looking at a bunch of different offers and some of them have conditions, et cetera, even, and I'll still put conditions, even in a competitive environment. So even when I was, telling you about that, I was one of 16 offers on that building. I had conditions.
Yeah.
Okay. But I was the most credible person buying it, right? And my conditions were reasonable. And so I'm, the buying agent in that case is selling it to the selling agent and say no. If this guy has the deal, if you accept his offer, unless there's something really wacky that you haven't disclosed, he's going to close on this. So that part of it helps.
Because the people doesn't want a tire kicker, to be honest. Like all of this relationship confirms that you're not gonna get away from the deal. So yeah.
So your reputation is critical, right, in these buying environments when a deal has to be done. The other is the relationships. I have not bought a building where I didn't personally know the seller.
Okay. Really? Okay.
Yeah. And it might have been that I only known them for about an hour, but I will take time to meet them.
Okay.
I always. And I use a variety of strategies for that. but I want to make sure that they understand that I'm a person. Okay. And I want them to know who I am. And when they're faced at the decision time between a blind offer and an offer from someone they've met, and they're reasonably equal terms or very close, they're going to have, unless you're a jerk, right? And I don't think I am most of the time, but
you're not. Don't worry. You're not.
but if they like you, right,
Yeah.
they're going to want to favor you.
Okay.
Okay. So that helps a lot too. So
Maybe we can talk about your techniques to meet with the owners.
No, yeah, we can definitely talk about that. And then, but let's finish off on your thing. The other thing too is because we have a reputation and we're present in the market, and because we do networking and we talk to people all the time, you find out who is planning on selling at any particular time. You have a feel for it, especially if you work in targeted markets. So rather than casting your field to let me look on MLS across all of Canada, if instead you say, for example, we focus in Centertown, Ottawa, we focus on Almont, we focus on Carleton Place. And if we focus on those specific markets, you get to know who the people are, the retailers, the other investors in that area. And you get to know who is likely to be selling, and you have a conversation with them. So, and then even when you go to do a buy, they know who you are and whether you're credible. So a deal that I got, for example, in March, the portfolio deal we talked about earlier, that was one where a realtor called us. He had it under contract. He was planning to do something with it. He was nervous about his ability to execute on that particular deal
for himself. It was under contract for himself. Oh, okay.
I think it was too big for him. It was something out of his well out of his comfort zone.
Yeah.
And so he called us up because he knows that we invest in the area, and he said, would you be interested in this? And I said, well, send me the numbers. I ran the numbers, and you know that commercial where the lady comes running into the store, jumps into the passenger side, tells her husband, start the car, right? It was one of those deals.
Yeah.
So I looked at the numbers and I said, this is either a great deal, because the realtor had actually done a good job of underwriting, to be fair. So, it wasn't perfect, and I was still able to knock off some
conservative words. You did conservatively more than him. It was more conservative for you. Okay.
He did a pretty good job, but I still had some ways to bring the price down.
Okay.
So, but because he'd done a good job, it was a 6 cap already, right? When I bought it.
Great.
And so I figured either, he's done a great job on the underwriting, or this building is a disaster, right? Okay. And so I said, okay, I'm going to go out and take a look at it. I was out there the next morning. We took a look at the building. The seller was there as well. And I looked at the building, and there were some challenges with it, which is how I ultimately knocked down more of the price on it. But at the end of the day, I took assignment of that deal, like literally that same day, because I saw there was going to be no issue with it. And I still inherited some of his conditional periods in there as well. So I just immediately called up my mortgage broker. I said, here's the pro forma on this, on the as is. I said, here's what it looks like on the as complete. I sent it to my appraiser, who I usually use as well. I said, Dan, can you take a look at these numbers? Will you support my, my underwriting and my pro forma here? And he replied back, within a couple of hours. He said, yeah, I'm good to go. He said, obviously subject to me doing all the inspections and looking at it. I said, but if it's what you say it is, I'd support this. So the numbers seem to make sense to me.
It was conditional or not?
I was still conditional at that period. I inherited the condition period. So in that one, I had my appraiser tell me he was comfortable with it that day. My mortgage broker said I should have no issue getting you a lender on this. And so I took assignment on that deal literally 24 hours after seeing it. And then that one was an interesting one, because that was what I was telling you about when I closed in March, just when Russia had invaded Ukraine and was driving the interest rates crazy. So it became challenging only because I'd advanced the close. So because at a 6 cap in that area, and with so much upside potential in that particular deal, it was cash flowing right away. So I was able to close that early, because that was another thing. The CMHC, as you know, usually takes about 10 weeks to do their underwriting.
Yeah,
I had that one back. I had it back in 4 days, Adam. 4 days. It's unheard of. Did you close?
Okay. You closed in 4 days?
No. The CMHC underwriting.
It's 10 weeks. Yeah.
Yeah, they did their underwriting in 4 business days.
How?
I know, it's unbelievable. So then I said, well, great. I had budgeted 10 weeks. So I asked the seller if we could advance the close by 2 months because
Okay.
it was cash flowing. I wanted the money now.
Okay. But he didn't wanna, or you closed early?
Oh yeah, we did. We closed 2 months early.
Oh, okay. Okay.
And it may have been a saving grace in the end because, the new close date was happening about the same time that Russia invaded Ukraine. Interest rates dipped a little bit, but then they started to spike, right?
So you
And
closed before the invasion. That's great.
no, just like probably 3 weeks in.
Which rate is? It was 2.5, 2.6?
Well, when I first underwrote the deal, I qualified it at about 2.5 to 2.75.
Okay.
And because that gave me a little bit buffer at the time, and CMHC underwrote it and had a limit of 3.45. So
During closing.
they said, as long as it's 3.45% or lower, we will insure it.
Okay.
So, but what was happening is when Russia invaded Ukraine, the bond market collapsed. And when the bond market collapses, what happens is the yields on those bonds, right? What the bond holder pays the person holding the bond, or the bond issuer pays the guy holding the bond, that's the yield. And so when you're getting a commercial mortgage or any fixed mortgage, quite frankly, what they do is they go to the bond market and they buy a bond, a mortgage bond. And then you're paying the yield price on it plus a spread for the bank, and that's what your interest rate is. So what was happening at that time was because the bond market was, due to fear of what was happening in Russia and Ukraine, and it was the bond yield was going up, right? Because you have to give a higher yield to create incentives for people to want to continue to buy your bonds. So as that was going up, I was looking at my interest rate costs going up very quickly over that period of time. So now I was in a real hurry to close as fast as I could because I wanted the lower interest rate. And even as it was, I ended up at 3.45. But in order to do that, the interest rates were actually a little higher at that point. So you have to do what's called a buy down on the mortgage. So I had to inject more money into that deal to, effectively make the amount of loans smaller, right, is kind of what it amounts to, so that they could still run it as if it was a 3.45.
Oh, okay. So what was the LTV on this to able to close the deal?
That LTV was 82%.
Oh, okay.
Yep.
Okay, so you bumped only 3% difference between 85 and 82.
Well, yeah, but remember, this is underwriting as a 6 cap with as is rents, and CMHC doesn't care about the upside, right?
Yeah, correct. Yeah,
just the as is.
Yeah.
And so it worked out with their underwriting at about 80% loan to value, which I consider a win.
Yeah.
But when I do the refi, and I took a 5-year mortgage on this one, so at the end of 5 years, I'll do a refi on that. The rents will, for the vast majority of the units, will be at market at that point, and I know I'm going to get all my working capital back out of it without a doubt.
So the plan is cash for keys, or
no? Well, the only time I really use cash for keys is if I've got a tenant that's creating problems.
Okay.
So like I said, I don't like to interfere with people's lives. I like them to live, in comfort without fear. Life throws enough anxiety at people. I don't need to be another source of anxiety. So we run a very ethical business, and I'll just wait for them to go. And that's why I picked the demographics. Now, if a tenant is being a pain in the butt with other tenants or with ourselves, so for example, if it's a non-smoking unit and they're insisting on smoking and they're bothering all the other tenants, we'll start with an N5 process and we'll go down that path. But then we'll have a discussion with them and say, look, we can go down to the landlord tenant board side of things. We can continue to pursue this N5/L2 application. But I'm going to make it easy for you, right? Because I don't think you're necessarily a bad guy. So what I'll do instead is I'll give you the equivalent of first and last month's rent for your new place, and maybe a moving budget of $1,000. Okay. But in exchange, I'll get you to sign this mutual termination. In Ontario, that's an N11 form.
Yeah.
So in those cases, I'll do a cash for keys. But if a tenant is otherwise a good tenant, I typically won't do that.
Okay. Okay. My final question would be the next event on June 8th on Ottawa. So tell me about the event and the organization. I think the name is Oreo.
Oreo, yeah.
Oreo, yeah.
So
It's just
the,
confusing with Oreo. So
it's confusing because of OREA, which is the Ottawa Real Estate or Ontario Real Estate Association, but no, it's Oreo, which is the Ottawa Real Estate Investor Organization.
Yeah.
So OREIO.org.
Yeah.
And thank you for mentioning that. So I sit on the executive team. I'm the vice president of the Oreo team. We're a club. We're a not-profit club. People pay dues. It's only $127 a year, but it's really just to pay for our costs. We hold it at the Infinity Center here in Ottawa. And so we meet once a month, typically. We're usually presenting really interesting topics for people to learn. And it's new investors as well as experienced investors get a lot of value out of it. I'm an experienced investor, and one of my colleagues, Victor Menache, who is also quite well known. He's a big developer, so I think he's got about 700 units in his pipeline right now, right? In terms of
I'm sorry, I didn't catch the name. Michael Chan?
Victor Menache.
Victor Menache. Okay, yeah. Okay, yeah.
He also hosts the Real Estate Espresso podcast.
Yeah.
So Victor's great. But we'll have a lot of newer investors as well. So we cater to both ends, and we do, so for example, last month we did a lot on detailed market analysis, understanding the dynamics in the economy, and we had an actual economist, right, a finance economist that was talking about it. We had someone from Denton's 2 months ago talking about proper structure of joint ventures, GPLP structures, and knowing that you're on side with the Ontario Securities Commission. So we had a whole session on that. On June 8th, we have Elizabeth Kelly and Cherry Chan talking. Elizabeth's going to be talking about various investment choices that investors have, especially in more challenging times like this, and what's the right investment decision or right investment strategy, if you will, in a time that's in flux, as well as meeting your own personal objectives. Cherry's going to be speaking about how to avoid audit traps and the things that a lot of investors make mistakes. Because they don't consult with their accountant beforehand, and they always should before they start a project. There's lots of things in the Income Tax Act that you can accidentally trip over, and if you get audited, it can be a world of hurt. So Cherry's going to be speaking to things to be aware of and avoiding the audit traps.
And you're going to be speaking, I think.
Well, I speak sometimes, but we like real people to present and offer value all the time. So I've certainly presented in the past, but it's those are the two main speakers. And then we usually do things like a deal share as well. So if people have a deal and they want investment partners, we also have an action taker segment. So people can say what they've done in the past month, something, whatever it is, a small step or a big step. So it could be something as simple as I've acquired my first property. It could even be I put my first offer in, right? Whatever achievement that they have, we like to celebrate people's success.
I think this is the biggest club in real estate in Ottawa, correct?
Yeah. We have probably about 400 paying members.
Okay.
And we bring a lot of guests come in as well. So the June 8th event is going to have a very large turnout, but fortunately we have a very large venue.
Especially after COVID, everyone is really in, you saw what happened on Toronto last week. Everyone was really exciting to see each other, like seeing faces and hugs and shaking hands and seeing actual faces. Like after 2 years, this was really hard on everyone, I think. So yeah, everyone is exciting about these events. So my last one, how people can follow your success on social media?
Sure. I'm always happy to help people, that want to follow what we do. It gives me a lot of energy, shall we say, to see other people succeed. So you can certainly follow. I mean, our website is my company's name is Aliferous. Okay, so ALIFEROUS, and it really means, it's Latin for with wings, right?
Okay.
I thought it was clever, and that's why our logo is wings.
So your background is Latin?
No, I'm French.
Okay.
But it's our website is aliferous.ca.
Okay.
On Facebook, we're Aliferous Group.
Okay.
On Instagram, Aliferous Properties. I think it's Aliferous Group on LinkedIn. But if you look for Aliferous, we're pretty much the only one. It's a registered trademark in Canada, so that limits other people from being able to use my mark.
Amazing. Again, thanks a lot for your time on this.
Yeah, and of course, Adam, you can follow me personally. So Christian Szpilfogel, I'm all over Facebook and LinkedIn. So
I think you're in Instagram too, or not?
I'm sorry?
You're in Instagram too, or not?
I am. I'll admit I'm not very active on Instagram.
Yeah. Okay.
But I spend a lot of time hanging out in Facebook and LinkedIn.
Okay. Again, thanks a lot for your time today. We're really happy to bring you again to the show. And again, I appreciate your time and accepting the invite.
It's my pleasure, Adam. Thank you for having me.
Thanks a lot.